Happy Friday, everyone. Hope we're doing well. Got a smaller class today, so yeah, it's gonna be a challenge. I'm curious, is everybody feeling okay this morning? Everybody good? Are we AYCD kick in? Is that what that gonna be the effect? I see people looking at me, and I'm not sure if that's just like you need something to focus on, or if you're actually listening to what I'm saying. Okay. So how many fingers am I holding up? Yeah, that's what. All right, all right. Yeah, we're gonna have a struggle getting through today, but that's okay. That's okay. Struggle makes us stronger. Struggle makes us stronger. So yeah, let's go ahead and get started. I want to actually remember to put hand these out last time. Again, I've been in a gabby mood lately. I don't know why, but I completely forgot to hand these out last week. I actually had them printed out, but I just forgot to hand them out so we could do them. So I'm going to try to make sure we get through those. Good news is I think our TBS will not take us nearly as much time as last week's. Auditor's engagement letter most likely would include what? We just talked about. I'm on the right. Oh, I'm on the wrong one. So that's what we just did last week. Okay. Why didn't somebody tell me that we were on the wrong one? Goodness gracious. That's what the problem when I get to the chatty mode is I don't pay attention to what's going on around me. I'm looking at my solutions like that does not match. And so, okay. Try this again. Which of the following procedures an auditor most likely include initial planning, financial statement, audit? So we're still kind of talking about planning procedures at a very general level. So we're during the planning phase. Which of the things would be something that be included in the initial planning phase? So obtaining a written representation letter from client's management. When does that occur? Is that during planning? So we have the management representation letter. That was a really, really weird document that we talked about. That was the document. Who drafts the letter? Which party? The auditor, okay, but it's addressed from management to the auditor. Have you ever written a letter to yourself? Does that ever happen? Well, you'll be doing that as an auditor, but yeah. So it's a really real document. That's one of those documents that we do when the audit concludes. So it's during conclusion step when we say, here's everything we provided over the course of the audit as management. We're going to sign this as management, even though auditor wrote it. It's really, really weird. Examining documents detecting any non-compliance with laws and regulations having material effect on the financial statements. That sounds like something we do during substantive procedures, so we're not there yet. Considering whether the client's accounting estimates are reasonable in the circumstances, that's another evaluation that's testing, so it'd be substantive procedures. At the very least, it could be testing controls. It could be either of each, but I would assume more likely substantive procedures. Determine the extent of involvement of the client's internal auditors. There we go. Now we're talking how much can we use the client's external auditors? Oh, by the way, there are 3 things we have to consider with respect to use of external auditors. So before we can say we're going to use your work, we have to evaluate our competence, objectivity, and the use of a systematic and disciplined approach. Does everybody remember that? Long time. And I think I mentioned this back in 417, just as a reminder, the first 2 are required under both sets of standards. Systematic and disciplined approach is only required under ECOB standards. So objectivity, compliance, systematic and disciplined approach. All right, I hate this next question. You may ask, why do you ask this question? I don't always ask questions that I want. I do think it's important to be able to convey certain concepts. I think that there's a very low percentage chance you would see a question like this on the exam, simply because they literally try to avoid tricky questions. And I think this one was not written with bad intent, but it came out as bad intent. So for which of the following judgments may independent auditors share responsibility with the entity's internal auditor, who is assessed to be both competent and objective? So there's objectivity and competence that we were just talking about. So this is basically asked a question, okay, the internal auditor is going to help us. When can we use their assessments? And the answer is never. Okay, we can never use their assessments. Can we use their work and assess it on our own? Yes, but they don't get to actually make judgments about inherent risk or control risk or anything related to the audit. They're just there to provide work, and we're going to utilize that work in some capacity to give us assurance. So they don't provide assessments to us; they just provide us the work. So this is the reason that's a trick question: is that if that's the case, how much are we going to rely on them for assessment of inherent risk? None whatsoever. They can't provide any assessment of inherent risk. So the answer is no. Assessment of control risk. The answer is also no. So that's the key. Now, if you got that question wrong, do not feel bad. The goal here was not to. If you got it right, congratulations, you saw through the veil. But if you got it wrong, the goal here was to clarify that with respect to internal auditors, we can utilize their work. We can utilize it to gain some assurance that they are not providing any assessments with respect to the independent external audit. Which of the following is least likely to affect an auditor's judgment about materiality? By the way, I apologize. I try to be very thorough whenever the word not or least comes up. I try to underline them, and I realize that I do that sporadically. Excuse me. So I got it on this one, but I missed one later on. So which of the following is least likely to affect judgments about materiality? So the nature of an item is an item such as a small, sorry, legal but very small payment. Okay, would that affect materiality? Probably to some degree. Okay, now this is a little bit of a misnomer because generally speaking, fraud. We're talking about fraudulent actions. There's not really a materiality threshold. But I think that if we identified a fraudulent transaction, then we'd say that would affect our assessment of materiality. So we could actually kind of backtrack and say identification of fraudulent transactions may cause us to revise materiality. So I think that's a fair statement. The client's evaluation of materiality. How much evaluation of materiality does our client get to do? None. They may independently determine that, but we don't use that as auditors. Okay, we don't care what client assess materiality. Our assessment is independent. So that's our answer. Let's go through the rest. Dollar amount of key figures in previous year's financial statements. Does previous year information affect our current period audit? Yes, that's a comparability issue, and it actually affects how we evaluate changes from period to period. So that would affect materiality. Consideration of what a reasonable person would think. That is by definition materiality. So that would actually be something that would affect materiality. Materiality affects materiality. We can come up with that statement right there. Jamie from MSM CPA firm is auditing RC airplanes for year 3. Jamie expects the users of financial statements to have a medium to high level of tolerance for the misstatements and to be most invested in earnings. You can tell when I slow down and speak very slowly that I'm focusing on important things. So the following guidance for materiality. So we've got our benchmark and we've got the tolerance for misstatements, which both of these were kind of alluded to. There's following information for RC airplanes with respect to revenue, assets, and profit before taxes, which I'm not sure why they included revenue on here, given that we don't have a benchmark, a percentage for revenue, but they did what they did, I guess. So based on the facts above, what is overall materiality that Jamie should use for RC airplanes? Now, if you did not read the question, which I'm assuming at this point in your careers in accounting, you're very good at reading questions. If you did not read the question, then you're just basically throwing darts at this. But if you did read the question, we're going to be focused on a medium to high level of tolerance. So it's this column right here. And then we're going to have to select our benchmark. And they're most interested in earnings. So that's going to tell us that we're going to use profit before taxes. So 6% of profit before tax, which is 250,000, 6% of 250,000 is $15,000. All right. I don't expect that was a stretch. This was more of a lesson, not how to calculate materiality, but make sure that you read the question very clearly and carefully to understand what individual elements from the question you need to use to answer the question. Again, I expect that you're very good at that right now, but more practice is never going to be a bad thing. The existence of audit risk is recognized by the statement in the Audit Standard Report that the what? What 2 words are we looking for with respect to audit risk? What 2 words are always relevant here? Dr. Barnes, those are the 2 words that are always relevant. All right, so it's 2 words that are in the audit report that reflect the existence of audit risk. Audit risk is inevitable simply because the auditor provides reasonable assurance. Okay, so we're looking for the answer that has reasonable assurance in there. Okay, so let's go through the answers. Auditors responsible for expressing opinion on financial statements, which show the responsibility of management. That is a true statement, but it's not relevant to audit risk. Financial statements presented fairly in all material respects and conforming to GAAP. That is also a true statement. Again, not relevant to audit risk. Audit includes examining on test basis evidence to support the amounts and disclosures of financial statements. That is relevant as well. Or sorry, that's true as well, but not relevant to audit statements. So hopefully D is correct. Auditor obtained reasonable assurance about whether the financial statements are free of material misstatements. We have a winner. That is the statement in the report that actually refers to the audit risk model. And we need to know that that is what we're looking for when we're talking about the level of audit risk. Now, keep in mind, what this alludes to is the fact that the auditor could do their job perfectly and still audit, or still we could have an issue with respect to material misstatement. They could fail to detect a material misstatement. So this statement is basically saying, look, we are reasonably certain that the financial statements are free from material misstatements. We're not absolutely certain. That's basically what we're trying to allude to there. That's the audit risk component there. As acceptable level detection risk decreases, the assurance directly provided from what changes? Okay, so this is an allusion to what we worked out on Wednesday. So let's go see if we can figure this one out. All right. So detection risk decreases, substantive tests should increase. What do you guys think about that one? You like that one? I like that one, but let's go through the rest. Substantive tests should decrease. Well, obviously, if A is correct, B cannot be correct. What about C? Test of control should increase. Now, what do we need to do before we can accept, or we can determine detection risk? We need to complete what? So we got our sequence of steps that occur in audit. We've got planning, risk assessment, test of control, substantive procedures, closing, reporting. All right. So what comes before substantive procedures? Give you hints. The first three words in one of these answers. Test of controls. Okay, test of controls. So in order to determine the scope of our substantive procedures, we have to complete test of controls. That's the intuition anyway. All right. So in other words, in order to establish detection risk, we need to know what test of controls tells us. Because remember, detection risk is predicated on inherent risk and control risk. And control risk is finally determined by completion of test of controls. So basically, test of controls has to be completed before we can actually determine detection risk. So can we change test of controls in response to detection risk? Not unless you have a time machine. That would be a really good audit tool. It's like we had a time machine. Actually, I'd settle for one of those time turners, like in the Harry Potter series. Okay. Is that a dated reference? Or does everybody still get that reference? Okay. Okay. Good. Good. I've been really struggling with what my dated references are and not my dated references. I think I've still got on my Office Illusions, like the TV show The Office. Everybody's kind of like, okay, I get that one, Dr. Barnes. But if I go a little bit too far back, if I go back to the 90s, then all of a sudden it's like, we're not sure. We weren't alive back then, which really makes me feel old. All right. Which of the following statements reflects an auditor's responsibility for detecting errors and fraud? Now, before we answer this question, let's go ahead and determine what the auditor's responsibility is. So we talked about this on Wednesday. I made a correct statement. The auditor has a responsibility for designing procedures that will detect errors and fraud that have a direct and material effect on the financial statements. So we're looking for some iteration of that statement. Designing procedures that have a direct and material effect. So an auditor is responsible for detecting employees' errors, fraud, but not for discovering fraud and by employee collusion or management override. Is that a true statement? That is not a true statement. Auditor has responsibility for all types of fraud. Auditor should plan the audit to detect errors and fraud that are caused by departures from GAAP. Auditor should detect procedures to detect all forms of fraud, not just departures from GAAP. So this is a true statement, but not a complete statement. Auditor is not responsible for detecting errors or fraud unless the application of gas would result in such detection. Nope, sorry. We have to, again, detect or prepare to detect all of them that are detect correct material. Auditor should design the audit to provide reasonable assurance of detecting errors and fraud that are material to the financial statements. That seems like the best answer to me, and that is in fact our correct answer. Okay, so direct and material effect, all of the possible fraud items. Which of the following journal entries an auditor least likely examined in an effort to address the risk of management override and controls? All right, so this is the one that I forgot to underline least, so you had to make sure that you pick that up. So in other words, the way that we're thinking of these, which of these is the least suspicious type of journal entry? All right, which of these is the least suspicious type of journal entry? That's the way you can kind of frame this question to make this straightforward. So let's go through the answers. A journal entry remains to record recurring periodic accounting estimates. Now, what's our suspicion level on something that recurs from period to period to period? Probably pretty low, okay? So this is likely our answer, but let's go ahead and compare this to the other answer, see if there's a better answer. A journal entry made by an individual who does not typically make journal entries, okay? So how suspicious would you be if like you're walking into your tax class and all of a sudden Dr. Barnes is up there teaching? Like this cannot possibly be right. There's a disturbance in the force, all right? Same thing here. Somebody who does not make journal entries, they're making journal entries all of a sudden. That's raises the red flags, okay? Raises the red flags. So B is definitely suspicious. A journal entry recorded as a post-closing entry that has no explanation or description. Now, I know that when you learned about journal entries back in 220 and 221, it was not common to give descriptions. You just like debit on the left, credit on the right, and write the amounts down. But a true journal entry should have an explanation, a description, and probably the details of the people who made the journal entries. Now, if you see a journal entry with basically just debit and numbers and no real depiction of what this journal entry is about to represent, how would you, as an auditor, respond to this? Like, I don't know, somebody who took 220, 221 at Chairman's Day. Yeah. Good on you. Yeah, no. We'd be very, very suspicious because we have to understand what is the nature of that journal entry. So making sure when we talk about, now keep in mind, these are talking about specifically manual journal entries, okay? So specifically manual entries. I guess you could have some descriptions that occur for automated journal entries, but those are going to be system generated, which are going to be fairly boilerplate. But if you have a manual journal entry, you want to know why was this journal entry made, okay? So why was this journal entry made? A journal entry made to a seldom used account. So this account very rarely gets posted to. All of a sudden, year end, journal entry to that account. Is it possible there's an explanation for that? Sure. Okay. It could be that this only gets activated at year end for very specific circumstances. But would that raise suspicion levels? Yes. Okay. It would still raise suspicion levels. So even though this is a possibility, it is less clear that this is going to be that the suspicion levels be lower than this one right here. Okay. This one is definitely one where I'd be like, that's something that I would expect to happen because I see that occur from period to period. So A is our answer. It's the least suspicious of all. All right. Let's go ahead and run through some situations. So this was a hit or miss series of questions. So basically what you had to identify are two things. You had to identify, first of all, what is the related fraud risk factor, which I expect everybody, well, I expect you did reasonably well on them. Some of them are not necessarily as straightforward as you might think, okay? And then you had to identify something that was a little bit more straightforward is, does it relate to misappropriation of assets or theft, or does it have to deal with fraudulent financial reporting? And I think, though, that was a little bit more transparent. But let's go ahead and go over these, and I'm going to open my solutions manual. I was looking through my solutions manual and comparing that to the answers, and I realized I had one of the answers recorded incorrectly. It was a grievous discrepancy. Like the actual answer, I was looking at this. This doesn't make any sense. Why do I have this recorded with this? And I say, oh, it's the wrong answer. That's why it doesn't make any sense. So I think I've corrected that, but we'll see what happens. All right. First one's a little bit of a challenge. Significant related party transactions that are not in the ordinary course of business. Okay. So if the organization allows related party transactions, which of the fraud factors does this most likely represent? Opportunity. Okay. Now, are related party transactions going to be more relevant to misappropriation assets or fraudulent financial reporting? Now, before you answer that, let me keep in mind that related party transactions under generally accepted accounting principles are required to be disclosed in the financial statements, which is a big hint right there in that direction. So which one is it? Fraudulent financial reporting, fraudulent financial reporting. So opportunity, fraudulent financial reporting. This one was one of the harder ones, actually. So we started out strong, but we'll move on. All right, this one's a little bit challenging, but makes sense once you think about it. Promotions, compensation, or other awards inconsistent with expectations. Now, if we're talking about inconsistent with expectations, is it likely that your expectation is like, oh, well, I only expected a 10% bonus, but I got a 100% bonus? Is that the type of expectation we're talking about? No, it's like, okay, I'm hoping to get promoted to senior, and they did not promote me to senior. I'm really, really disappointed and bummed about this, okay? So what do we call that in that situation when it happens, when your expectations are not met? That creates incentives to act against the company or pressures to act against the organization. And if you're an employee in the organization, are you more likely to commit financial statement fraud or misappropriation of assets? I'm gonna steal cash because I want to make up for the fact that they didn't give me the money I earned. Misappropriation of assets. Yep, what's there? Again, that one's a little bit more challenging, but if you frame it properly, that makes a lot more sense. Significant bank accounts in tax haven jurisdictions for which there appear to be no clear business justifications. Now, this one's pretty straightforward, okay? Company has bank accounts that they can use for seemingly unknown purposes. What does that represent? Opportunity, okay? And then what is this going to be most likely related to? Misappropriation of assets or fraudulent financial reporting? Probably fraudulent financial reporting. You can make an argument for both, but I think that it would probably apply fraudulent financial reporting. I think if we're talking about situations where it'd be misappropriation of assets, that could occur. It's unlikely that somebody would misappropriate assets into a organization-owned entity. Possible, but it's not likely. Large amounts of cash on hand or processed. Woo! This is pretty straightforward. So this is pretty obviously which of the two types of fraud risks. What's up? Yeah, so it's fraud risk factors. It's opportunity. I was going to say, I was going to try to do the last one first, but you're right. It is opportunity for sure. Okay, now is this going to be a misappropriation of assets or financial fraud risk? Misappropriation of assets. Like, okay, big piles of cash sitting on a table. I think I'm going to write it and make sure that there's bigger piles of cash. No, you're going to go and you're going to take some of that cash and put it in your pocket. Has anybody seen the movie Casino, by the way? It's an older film, but I've been seeing YouTube clips on that. I'm not sure what's going on with my algorithm, but fantastic film, Scorsese film. And there's actually this one scene where they're talking about the mafia bosses are actually talking about how some of their employees are stealing from them, which is funny because the mafia bosses are stealing from the casino. And so I think that's That may be a little bit too much of a misappropriation of assets when you get mad about people stealing from stuff that you're stealing. All right. So I guess there's no honor among thieves. But we talked about that yesterday, didn't we? All right. Got my eyes on you, Ben H. All right. Large amount of accounting process, that's going to be opportunity misappropriation assets. Ineffective board of directors or audit committee oversight of internal control. So basically, there's very little oversight. There's a bad control environment in the organization. What does that represent from a fraud risk perspective? Probably opportunity. So what is going to be the more likely scenario that the opportunity would represent? Financial fraud, financial reporting, fraudulent financial reporting. That's what I'm trying to get to. All right, inadequate physical safeguards over cash investments or inventory. Boy, we're just running along with the same thing. Is this opportunity? This is definitely opportunity. And what does this relate to? Misappropriation of assets, okay? Yeah, got cash just lying around. It's like, hey, don't take this. Like, I've got to take it. All right, let's go, let's mix things up a little bit. New accounting, statutory, or regulatory requirements. So think about this. If we're talking about a change in accounting principles, like a big change in generally accepted accounting principles, does that represent a burden upon many organizations? I mean, the very basic, it's going to actually change the way they have to report, which is going to incur additional costs. But it could affect revenue recognition. Like, say you're Enron and all of a sudden they say, okay, you can't do mark-to-market revenue recognition anymore. Are they going to say, oh, well, this is what our bread and butter was. This is how we were able to get so much revenue. What are we going to do to keep our revenues up? Well, we're going to commit fraud. All right. So what does this represent out of the fraud risk factors if we have a new requirements that we have to meet? It's a pressure. It's a pressure. And then what are we talking about? Is it fraudulent financial reporting or theft? Fraudulent financial reporting. Yeah. Pressure, incentive pressure, fraudulent financial reporting. All right. Management has significant financial interest. Oh, sorry, excessive interest. Excellent. Looks like this way. Excessive interest by management in maintaining or increasing the entity's stock price. Now, this one's a little bit tricky. Okay. I'm curious as to what you all answered for the fraud risk factors because I don't think there's a clear-cut answer here. So, does anybody answer incentives or pressures? I think there's a legitimate argument for that. The book actually says Becker actually says that it's attitudes rationalization. I would not be happy if this was a CPA exam question and you had to choose one because I think you can make an argument for both. All right. I think the argument that Becker makes here is that this is not something that's a requirement of management. They're just kind of saying we want to increase our own circumstances, so we're going to rationalize our behavior so we can basically make ourselves wealthier. Already wealthy, wealthier. That's a stretch. I recognize that. And if you said incentive or pressure, if I was putting this on the CPA exam, I would accept both. Unfortunately, I'm not your tester for the CPA exam, so. But we can actually say that this is pretty clearly fraudulent financial reporting or misappropriation of assets. We're talking about stock price, and we're probably concerned with fraudulent financial reporting. I knew we'd get there. Management has significant financial interest in the entity. Now, this one's a little bit more straightforward, okay? If the entity does poorly, management will suffer. So can we say there's an existing incentive already there? Yes, so this is definitely going to be pressure. And just like the previous one, this is going to be fraudulent financial reporting. I know it was only Clayton saying that, but it seems sounded like a roar from the entire crowd. So yeah. Appreciate the enthusiasm, man. All right, inadequate monitoring of controls, including automated controls and controls over interim financial reporting. What do we got here? Opportunity. Yeah, this is definitely an opportunity. And this one's a little bit tricky because I think you can make an argument for both types of fraud, but which is more prevalent here? Financial reporting, because it actually says financial reporting here. So it kind of alludes to the fact that we're more concerned about the controls over financial reporting. So opportunity, financial reporting. Management failure to correct a known significant deficiency on a timely basis. This one's a tricky one. So we know the type of fraud here is going to be financial reporting fraud. Okay. But what is basically, how can we frame this particular statement? Is this an opportunity? Not really. This is more of an attitude that management has. This is kind of the approach that they have to the particular environment. This is not talking about the ramifications of that approach. This is saying their overall attitude. So I think that this is how they frame attitude rationalization. Again, I don't particularly like the way that the wording works in this one, but I understand the intuition behind it. So If you struggled with this one, or if you struggled with this one, I wouldn't beat yourself up over it too much because those are a little bit suspect. But everything else I think was pretty straightforward, and hopefully you found yourself doing pretty well in that. All right. Well, I forgot about it last week. I did not forget about this week. Let's go ahead and try some questions. Okay, so some questions that we need to go through here. So these questions seem pretty straightforward, but there's a lot going on in these questions. So let's go ahead and break them down. Holding other planning considerations equal. Now, this first statement is actually really important. We'll talk about why here in just a second. A decrease in the amount of misstatement and class of transactions that an auditor could tolerate most likely would cause the auditor to do what? Now, let's go ahead and think about this question before we think about the answers. If we decrease the amount that we can accept for misstatements, so we actually say we're going to set materiality lower, does that mean that we need more or less assurance in our testing? We need more assurance. Okay, so we're looking for an answer that represents more assurance. All right. Now I want to look at A and D. Apply the planned substantive test prior to the balance sheet date. Does that give us more or less assurance? Less assurance. Remember, the closer we are to the balance sheet date, the better the assurance level is because we have more information. All right. So that's why A is not correct. D, decrease the extent of auditing procedures to be applied to the class of transactions. Does that provide us less or more assurance? Less. If we do less testing, it's going to give less assurance. So we can eliminate A and D because we know that we need more assurance rather than less. Now, B says perform the planned auditing procedures closer to the balance sheet date. Does that provide us with more or less assurance? More. Okay, so B is our answer, but I want to talk about C because C is not intuitive. Increase the assessed level of control risk for relevant financial statement assertions. Now, this is tied to the idea of materiality. If you remember all the way back from 417, we also talked about this at the beginning of the semester. There are three concepts that relate to auditors' assessments. There's materiality, audit risk, and evidence. Now, these are the first two, and these are two that affect the nature, time, and extent of procedures. But these are independent of one another. So when we assess materiality, that does not affect our audit risk, and we change audit risk or any of the elements of audit risk, it does not affect materiality. Those are independent assessments. So this question, even though it looks like, okay, if we're increasing the level of control risk, we're saying that we're adapting for more possible assurance. That's a correct intuition, but it's not the correct application. All right. Now, this one was a really challenging question, but I do want to throw that in there. You can easily get down to B or C. The one is that seems the most apparent, the most obvious, is going to be the one that you want to hold on to, which we know performing planned audit procedures close to the balance sheet date will directly provide assurance. Yes.
When you say like closer to the balance sheet date, I'm assuming like for a normal organization that would be 12/31.
Yeah. So whatever their year end.
Right. So like, are you talking about before the balance sheet date or after the balance sheet date?
It could be both. Okay, but the way that this statement is worded, it just basically says we get closer to the balance sheet date. So say that we're originally going to do interim testing as of 9 months, and then we say we have misstatements that we're concerned about. So all right, let's change interim testing to 11 months. That would still provide us with more assurance than the previous alternative because we have more information. Now, optimally, we'd want to wait till after the balance sheet date, but the way this is worded, it still provides more assurance than what the alternative is. All right. Which of the following characteristics most likely would heighten an auditor's concern about the risk of material misstatement in the entity's financial statements? All right. So this one is pretty straightforward if you just look at the first answer because it says the entity's industry is experiencing declining customer demand. All right. So we're talking about an industry that's undergoing change. What do we know about that when we talk about that from an audit risk perspective? Does that increase inherent risk or decrease inherent risk? Increases inherent risk. Okay. If we have increased risk, is there an increased risk of material misstatements, especially due to fraud? Yes. So this was one that's most likely to be one that we could identify. Now we're still going to go through the rest to see identify answers, but A is our answer for the addition we talked about. B is an interesting one. Employees who handle cash receipts are not bonded. Now I realize this is not fair because if you don't know what bonding is, you couldn't pull out your phone and start looking stuff up because of the way that I've set stuff up. But does anybody know what it means to be bonded? Let me ask you this instead, okay? Has anybody heard about after you get arrested, somebody posts bond? Okay, what does that represent? The answer is that bail is what the organization requires the entity, whether that be the city or the state or the federal jurisdiction, to post bail. That's an amount that has to be given to them. And then the bond is basically something that's included with the cost of that, which is a form of insurance. So if you are on bail and you run, whoever posts the bail gets this bond money back. Gets this bond money back. So it's a form of insurance to actually prevent bad behavior. This can exist in other capacities as well. Employees working for an organization could be bonded, which basically means if you steal from the company, we've got insurance against providing theft. All right. Now, all that being said, how many people were familiar with the concept of being bonded as an employee before you read this question? Not something we really talked about. And I want you to remember that if it's something that's complicated and something that seems like in very, very niche relevance, probably not the correct answer. Okay. This is a really, really important concept to remember for CPA prep is don't make up information that doesn't exist. So B is out. I'm running out of time. Sorry, guys. Bank reconciliations usually include in-transit deposits. Do reconciliations often include in-transit deposits? Did you all do that when you were doing bank reconciliations back in 302? Yes, all the time. Okay, they include them all the time. It's not a big deal. Equipment is often sold at a loss before being fully depreciated. Would you be concerned about risk of material misstatement if the company actually recognizes and acknowledges loss? I would be less concerned about that because that's actually proper financial reporting. So A is the only real clear answer there. That's our Josh. All right, have a good weekend. See you all on Monday.